This week was a tale of two markets, a celebration of tech earnings quickly overtaken by a wave of macro-driven selling. Microsoft crushed expectations, surging nearly 10% after reporting blockbuster cloud and AI growth, but Apple and Amazon stumbled post-earnings, sliding 5% and 8% respectively as investors focused on softer guidance and competitive concerns. Then, just as tech bulls were catching their breath, the market was hit with what economists are calling the worst major economic report in the post-pandemic era. A shockingly weak July jobs report and renewed geopolitical tension between the US and Russia sent the Nasdaq plunging 2.2% and the S&P 500 down 1.6% in a single day. This is the kind of moment Warren Buffett had in mind when he famously said, "When it rains gold, put out the bucket, not the thimble." And right now, gold is falling in the form of high-quality tech leaders that just got cheaper. The dips in Microsoft, Amazon, and Apple could be prime opportunities for long-term investors willing to look beyond the immediate turbulence. In today's macro environment, with interest rate cuts now highly probable, inflation pressures easing, and fears temporarily outweighing fundamentals, these mega-cap tech stocks stand out as rate cut beneficiaries, defensive growth leaders, and tariff-resilient plays. The question isn't whether they'll weather the storm, it's whether you'll take advantage of the window it's creating. In this video, we'll break down Microsoft, Amazon, and Apple, examining the real drivers behind their earnings moves, why these dips align perfectly with Buffett's wisdom, and whether now is the time to bring out the bucket. Let's begin with Amazon.com Inc., ticker symbol AMZN, a company that just gave investors a textbook example of why market pullbacks can be opportunity in disguise. After posting strong second quarter results, Amazon stock slid 8%, largely because AWS growth came in slower than Microsoft's Azure and Google Cloud. But here's the thing, AWS still grew 18% year over year, pulled in $30.9 billion in revenue, and generated over $10 billion in operating profits at a remarkable 33% margin. That's not weakness, that's dominance. Amazon remains the #1 cloud provider with about 30% global market share, serving a who's who of enterprise clients from PepsiCo to Warner Bros. Discovery. AWS is on a run rate of $125 billion in annual revenue and could cross $50 billion in operating profits within the next year. The cloud business isn't just growing, it's highly profitable, and it's expanding into frontier areas like generative AI services, Bedrock Agent Core, and enterprise-wide AI deployment. And it's not just AWS carrying the load. Amazon's e-commerce and advertising segments continue to accelerate, proving that the company's diversified growth engines are firing together. In the second quarter, total company revenue jumped 13% year over year to $167.7 billion, beating Wall Street estimates. Advertising, in particular, has emerged as a hidden powerhouse, benefiting from Amazon's unmatched customer data and growing video streaming footprint. The broader US cloud market is expected to grow sevenfold by 2034, hitting $3 trillion. Amazon, as the largest and most established player, is positioned to capture a substantial piece of that expansion while leveraging AI to keep its edge. Short-term market jitters aside, the long-term story is clear. Amazon's leadership in cloud, its expanding AI capabilities, and its diversified revenue streams make this pullback look far more like an invitation than a warning. This is exactly the kind of setup Warren Buffett would describe when he says, "When it rains gold, put out the bucket, not the thimble." For patient investors, Amazon's dip could be that golden rainfall. Next, let's turn to Microsoft Corporation, ticker symbol MSFT, a company that just delivered one of the most powerful earnings performances of the quarter. While the market may have been rattled by weak economic data and geopolitical tensions, Microsoft's fundamentals remain rock solid. In its latest quarter, revenue surged 18% year over year to $76.4 billion, with its intelligent cloud segment home to Azure, jumping 26%. Azure alone is now running at an annualized $120 billion in revenue, positioning Microsoft as the clear #2 in global cloud infrastructure behind AWS and closing the gap. What really stands out is how Microsoft converts that growth into profits and cash flow. The company generated $25.6 billion in free cash flow in just one quarter, putting it on pace for an eye-popping $100 billion a year. That kind of financial firepower allows Microsoft to invest aggressively in artificial intelligence infrastructure, expand its data center network, and still return capital to shareholders through buybacks and dividends. Azure is also deeply intertwined with Microsoft's broader broader product ecosystem from Office 365 and Teams to GitHub and LinkedIn, creating a sticky customer base and cross-selling opportunities that competitors envy. The company is embedding AI capabilities across its product suite, making Azure not just a cloud platform, but a launchpad for enterprise AI transformation. Looking ahead, Microsoft is well-positioned to benefit from the multi-trillion-dollar cloud and AI markets expected to expand over the next decade. It's also a stock that could shine in a softer economic environment thanks to its recurring revenue model and dominant position in mission-critical business software. In short, while the market may be handing investors a brief window to pick up shares after the recent pullback, Microsoft's long-term growth story hasn't just stayed intact, it's accelerating. For those following Warren Buffett's advice to put out the bucket, not the thimble, when opportunity reigns, Microsoft looks like one of the most compelling buckets in tech right now. Finally, let's turn to Apple Inc., ticker symbol AAPL, a company that just proved once again why it's one of the most resilient names in technology. In its latest quarter, Apple delivered 9.6% revenue growth and an impressive 12.2% jump in earnings per share. iPhone sales surged 13.5% year over year, showing renewed strength even in a market that many believed was nearing saturation. But the real star of the show continues to be Apple's services segment, which posted another quarter of double-digit growth, powered by its expanding ecosystem of iCloud, Apple Music, Apple Pay, and a growing subscription base. This high-margin business is becoming an increasingly important profit engine for the company. Apple also signaled its long-term vision in AI. The company has quietly rolled out more than 20 AI-driven features, with plans to launch a far more advanced personalized Siri next year. While some investors were disappointed that these AI enhancements are arriving later than competitors, Apple's deliberate approach could pay off, ensuring that when its AI tools debut, they are fully integrated across the ecosystem and deliver a seamless user experience. With over 1 billion active devices, even modest AI-driven monetization could be a major revenue driver. Looking ahead, Apple expects mid to high single-digit revenue growth in the next quarter, with services continuing to lead the charge. The upcoming iPhone 17 launch, combined with AI upgrades and continued growth in wearables and payments, positions Apple to return to a more normalized 9% annual growth rate from fiscal 2026 onward. Yes, there are near-term risks, notably tariff threats under a potential Trump administration, but Apple's brand loyalty, innovation pipeline, and unmatched installed base make it a defensive growth leader. For long-term investors, this recent post-earnings dip looks less like a warning sign and more like a Buffett-style opportunity to put out the bucket, not the thimble.